Imagine discovering that the safest sounding corner of finance is built on loans you can't see, prices no one can truly check, and fees that keep flowing even when the borrower is quietly bleeding. That is private credit, the $1.7 trillion shadow bank hiding inside pensions, insurance portfolios, and steady income funds. But the weirdest part is not that private credit exists. The weird part is how calm it looks. On paper, the loans barely move, the returns look smooth, the risk looks sleepy, and then, in stress, investors suddenly learn the door was never really open. So what is private credit? Imagine a company needs money. It could go to the bank, it could sell bonds to public investors, or it could go to a private credit fund, a giant pool of money run by firms like Blackstone, Ares, Blue Owl, Apollo, or KKR. These funds lend money directly to businesses, usually not Apple or Microsoft, smaller, riskier, often private equity-owned companies that need speed, certainty, and flexibility. And in theory, it's useful. Banks became more careful after 2008. Regulations got tighter, some companies still needed loans. Private credit stepped in and said, "We can move faster. We can customize the deal. We can give you the money without the circus of public markets." That is the clean version. And for investors, the sales pitch sounds beautiful. You get higher interest than public bonds. The loans are often senior secured, which means if the borrower fails, you're supposed to be near the front of the line. The loans are usually floating rate, so when interest rates rise, your income can rise too. And because the loans are private, they do not get marked up and down every second like stocks or bonds. So the chart looks calm. A pension fund looks at it and thinks, great, stable income. An insurance company looks at it and thinks, great, long-term cash flow. A wealthy investor looks at it and thinks, great, rich people, fixed income. But this is where the magic trick starts, because private credit does not just make money by lending at high interest rates. It also makes money because the whole system is darker, slower, and harder to check. A normal bond trades in a market. You can see the price. If investors panic, the price falls immediately. Private credit is different. Many of these loans barely trade at all. So when something goes wrong, the value is often estimated using models, appraisals, and judgment. That sounds boring, but it is everything. Because if the manager controls this estimate, and the manager also earns fees back on the size or value of the fund, then the manager has a very awkward incentive. Do not mark the loan down too quickly. Nobody has to scream, nobody has to lie in a cartoon villain way. The machine can simply move slowly. A company weakens, the loan gets amended, the interest becomes pay in kind, meaning the borrower does not pay cash today. The unpaid interest gets added to the debt. The fund still reports income, the manager may still collect fees, and the investors still see a smooth looking number. It is like a restaurant saying, it made a profit because a customer promised to pay for dinner next year with another dinner added on top. Now zoom out. Private credit has grown from a niche market into something enormous. Recent estimates put US private credit around $1.34 trillion and global private credit fund assets around $1.7 trillion. That means that this is no longer some weird Wall Street side room. It touches companies, banks, pensions, insurers, and ordinary retirement money. And the fees are not small. A private debt fund might charge around 1.4% a year during the investment period. That might sound less than a private equity, but remember, this is debt. The loan portfolio earns 9 or 10%. A 1.4% fee is a huge bite. Then comes the other layers. Incentive fees, distribution fees, leverage fees, SPV expenses, origination fees, structuring fees, waiver fees, amendment fees. And some fees are paid by investors, some are paid by borrowers, some can feed into the income number that creates even more fees. This is why the economics feel disgusting. The product is sold as a simple income, but underneath it can become a toll road where every turn adds another booth. And then there is liquidity. Many investors are told they can get money out periodically. Not every day, but maybe every quarter. That sounds reasonable, until too many people try to leave at once. Then the fine print matters. Some funds have repurchase caps. If the cap is 5% and investors ask to pull out 11, not everyone gets out. Some people get partially paid. Some stay trapped, and the people who remain may be left holding assets that still have not been fully marked down. So the exit exists unless everyone needs it. That is the hidden danger of semi-liquid products. They sell the feeling of liquidity without owning liquid assets. To be clear, private credit is not automatically the next 2008. Many private credit funds are not as reckless leveraged as banks were before the financial crisis. Some loans are genuinely well structured. Some managers are careful. But the problem is not only collapse, the problem is extraction. The system can extract from the borrower, who pays expensive private money because they need speed. It can extract from the investor who pays layers of fees for returns that may not beat public credit after proper risk adjustment. And it can extract from trust itself, because the smoother the chart looks, the easier it is to forget that risk has not disappeared. It has just been delayed. This is the dirty secret of private credit. The industry's greatest strength is also its greatest weakness. Nobody can see clearly enough. Not the investor, not the regulator, sometimes not even the lender until the borrower is already in trouble. And when stress comes, the truth does not arrive like a lightning bolt. It arrives slowly, through redemption limits, through quiet markdowns, through lawsuits, through defaults, through strange little phrases like valuation adjustment and payment in kind income. Private credit is not disgusting because lending money is evil. It is disgusting because the industry has found a way to sell calm, charge for complexity, delay the pain, and call the whole thing stability. And maybe the most dangerous part is this. By the time everyone can finally see the risk, the fees have already been paid.